All right, all right, all right. Here we are again. I know it's work. It's work. We have to do some work today. It's work time. Gird up your loins and let's get ready to do some work. Today we're going to talk about rebalancing our portfolios. And why do we rebalance our portfolios in September? Well, we rebalance our portfolios in September in preparation for tax season, which happens in the end of the year. So we have to be ready to. It just happens to be when everybody else does it. Okay. All the big firms, they need extra time. You and I, we're tiny. We can rebalance our portfolios in what do they say? 2 weeks of a cottontail's tail, rabbit's tail. We can do our portfolio rebalancing relatively quick, usually. But we need to have the right tools to help us know what to rebalance into and why we might rebalance and maybe why we shouldn't rebalance. Today, we're going to talk about rebalancing our portfolio. All right. And so this is kind of a follow-up on our conversation that we had on Tuesday morning. And so what I want to do is I want to go through it and I want to bring up our new software tool that we're using. All right. That's called Portfolio Matrix. And we're going to start off with that. If I can find it. There it is. So this is Portfolio Matrix, and I'm already logged in, got all my stuff up here. And what we're looking at is we're just looking at our rebalancing of our portfolio. And so I want to come through and I want to show you just real quick. These are my trades, and this is my income. This green line is my income. This is the dividends that come through. This is the NAV. Right, as we adjust. And I've been adjusting right here. That's what this is. This is adjusting of my NAV. And then this is my cash cow. So this is how my cash cow is coming almost there. Those two lines touch. Of course, I keep taking money out and put it in. I'm doing a little rebalancing here. So this is kind of getting a little jiggered up in here. But as you can see, this is my cash cow line. So that's what that is. And then this here is my monthly payouts. So you can see all of my monthly payouts for the whole year. And we can see all the different stocks that I've been in. This is just for my UBI account. And then as we come down, you can see the totals at the bottom. So the monthly total is 39,000. So it's very much almost exactly like my spreadsheet, except for it's more accurate because it's got closed positions in it. It's got everything in there, and it's got all the history. And I'm doing it. I can do it by, like right here, I'm doing it over the past year. I could do just year to date, and I would see what I got on my current spreadsheet, which is just year to date. But this is going back for one full year. And so it charts my NAV. Now, as we've talked about before, this little growth chart right here, this is what you see if your brokerage firm shows you. They don't show you this. This right here is basically the whole reason we created this program in the first place, because this is what you see on your brokerage account. This is what is really happening. All right. So you can see as we come in, and then of course your brokerage firm would never show you this. They don't show you this chart at all. They only show you this chart down here at the bottom. And so if you're trading the yield max funds, they would show you that you're probably not making any money. And in some cases, even because we've done some rebalancing, it just shows you that we've lost money. But in reality, because we are trading options, right? We're not trading for growth. We're trading options and collecting the premium. We don't have growth, so there is no growth. We don't have growth. Sometimes, I mean, our stocks will go up a little bit, right? Our yield max funds will go up, but mostly they're not growing. We get all of our money from the selling of options premium, and so that's what this green line is, and that's what this is. This is when our options are coming to fruition, and we're getting the premium. And so that shows our total dividends for the year at $413,000. That's pretty cool, right? And so we've had our NAV has a little bit of decay in there at 106. So we totally made this year, just in this one account, my UBI account, $307,000. All right. And so that's pretty nice. And then this, again, this is our cash on capital. And so that's just a chart that shows you where your break even is. And you can see it's coming together. And when those come together, I'm what I call a cash cow, right? I have no more out-of-pocket risk. They've given me back 100% of everything I gave them to trade with. And then at that point, I'm on the gravy train and I have no out-of-pocket risk. And I've also got exponential growth because I have no base cost. I have no cost basis. I have no cost basis. I'm trading on the house's money, as we say, right? All right. So at that point, I'm real close here. Of course, I keep putting more money in and keep reinvesting. And so those numbers will keep pushing out into the future, which is fine because it doesn't matter to me. I can just keep living off of it. All right. So I've got all this money coming in, 39,000 a month, 44,000 a month, 40,000 a month, 37. And that's just this account. I got two others. I got the traditional IRA and the Roth IRA. The Roth's tiny. It's not even worth talking about. It's a why bother market. But the traditional, that's a pretty good account. We can click on that and see all the totals on it too. So I think it's coming in at around 10 or 15, 20,000 every month. So maybe not that much, 10,000 a month or something. So add another 10,000 to that one on my traditional IRA. So that's how this is working. But now it's time to rebalance. All right. It's time to rebalance. You have to look at it and say, well, what are you investing in? Well, I'm investing in all these things, all these crazy markets. And you can see some of them I got into and didn't like and got back out. And some of them I got into and didn't like and got back out. Yeah, look at this one, BAH. That one wasn't a yield max fund. That was when I can't remember what I did with that one. Made a whopping $17 on it though. And then this is yield max, making about 207 on that one. So you can see some small ones in there. So I need to rebalance. And rebalance just means that we're going to rotate, or what we call roll, our money out of one into another. Now, you know that I rolled, see, it's BIDO. We rolled into BIDO and out of BIDO. So BIDO, I might have done that over in my traditional IRA. But we rolled out of YBIT, which is right here. There we go. So we were making money on YBIT, and you can see it was doing really well at first, 10,000, 8,000, and then it started going down, 6,000, 4,000, 4,000. And we had a real good month, 9,000, then 3,000, then 4,000, and then 6,000. And then we were watching BIDO, and BIDO was actually doing better percent-wise. And so we rolled over into BIDO. All right, we haven't got our first actually, we got some, last night I got some dividends. Let me look and see real quick. I'll tell you what they are. What were my, oh, I didn't snap a picture of them. See if I can find them. There they are. All right. So TSYY, I got $1,500. TSYY. That might be in the other account too. Is it? Oh, TSLY. Anyway, TSYY, I got $1,551 yesterday. On NVYY, I got $951, and NYYY and VYY, I got $1,297. So those were dividends that came into me last night while I was watching a movie. I was getting bing. Hey, Len, you just got $1,500. Bing, Len, you just got $951. Len, you just got bing, $1,297. I kind of like that. Sitting in the movie, making money. That's good. That's the way we like it, right? All right. So we're going to rebalance. So what are we going to rebalance into? And we're going to use this tool because this is just the reports page. So this is just the sizzle page. We're going to come up here and we're going to do some work. We're going to come in here and we're going to go to set targets. So I told you we're using this little tool here last week or on Tuesday, and we were looking at all the charts. Now what we did is we went down through our list of charts. So over in our calculator, right, our Pitt News Magazine calculator, we go down through this list, and I put in here $10,000 and calculated that. And the little Pitt News Magazine calculator comes through and tells us what the highest payers are, right? And we learned something very important from this. We learned that the highest payers are only telling us part of the story. And this is what we've been doing all of our analysis on in the past, is just kind of the yield. And then we'd come over and we would look in the charts and we would do all this hard work kind of manually, right? And these are the charts that I've got pulled up that I'm looking at. Now, what I did on Tuesday morning in class is I went down through every single one of these, and you can see I got a book here where I wrote them all down, and there's multiple pages of them. There's more over here too. So I've done a lot of homework for us. All right, you can't see all this stuff. There it is. So you can see I got multiple pages of all my notes on what these on on what all these funds have done. All right, so I did the math for us, and I spent a lot of time on this. So I'm going to share this with you now. I'm going to share my reports. Again, I'm not here to tell you guys what to do. I'm just telling you what I'm doing. All right. If you guys want to learn from what I'm doing, you can just follow along with me and kind of, I'll tell you what I'm doing, and you can decide if it's good for you or not. So you have to make your own decisions, but I'm doing all the work. I'm doing all the math. So I sit here and spend all day long doing all this math for you, and then I come and share you my results. And so now I've got all of these in this little calculator, this Pitt News calculator, the investment calculator, and it tells us which one of these high yield single stock ETFs are paying the highest returns and which ones have the highest risk. All right. So you have high risk, you have very high risk, you have moderate risk, and you have low risk, and you have low to moderate risk, and then you have very low risk. All right. And of course, that comes back to your payback time too, how long it's going to take them to give you your money back. And that's what we're really interested in, right? That comes right down to brass tacks. What's the most important thing to us? It's how fast they can give us our money back. All right. So that we're playing on house money, so that we have zero out-of-pocket risk, and we have what we call a zero cost basis, right? Wouldn't that be cool if you had a zero cost basis on all of your investments? Well, that's what we're working towards. We want to have a zero cost basis, because if we have a zero cost basis, then we have the ability to participate in that. That's the goal, to participate in that 7 wonders of the world, which is the exponential compounded growth. And I'm going to go off on my little tangent here real quick. Most people don't ever in the stock market participate in the exponential compounded growth. They get linear growth, and they're just not aware. They're just not aware. The whole name of the game to get exponential compounded growth is to have a trading strategy that gives you more shares. All right. And you have to get those more shares with house money. Just going out and working at McDonald's to come in to buy more shares is not going to get you exponential compounded growth. That's going to get you linear growth. All right. So if you come in and you buy 1,000 shares of Microsoft, and in 30 years, you still have 1,000 shares of Microsoft, you didn't have the 7 wonders of the world. You didn't participate in exponential growth. You participated in linear growth. All right. If you come and buy a house for $200,000, and in 30 years, that house is worth $600,000, you still only have one house. It's more expensive, it's of greater value, but you still only have one house. Exponential growth, exponential compounded growth would mean that you bought the house for $200,000, and then in 30, 40 years, you have 30, 40, 50 houses. All right. That's exponential compounded growth versus linear growth. So if you think about it like that, if you come in and buy 1,000 shares of stock, and in 1,000 years, or in 1,000 years, you'd be rich beyond your wildest dreams. Why would you bother anyway? But no, we're not going to live to be 1,000 years old. Therefore, we can't worry about a 1,000-year growth spurt. Although I do know a couple of people. Anyway, the point here is that we need to generate more shares based on the profits that we make. So if you're going to do it by trading, that's what the difference between trading and investing. All right. If you're going to invest in Microsoft, you're going to get linear growth. You're going to go in, you're going to buy 1,000 shares of Microsoft, and it's going to grow over a period of time. And at the end of that time, you're going to have 1,000 shares that grew to be twice or 3 times what you paid for them. That's great. Wonderful. But that's also the reason why you can work your entire 30-year, 40-year career and dump money into a 401k, and at the end of that 40 years have $130,000 and not $40 million, because you didn't participate in exponential compounded growth. You participated in linear growth. All right. And every dollar, every share that you bought, you had to work for it. You had to go out and you had to work at McDonald's, or you go out and you had to work somewhere to get that money to buy more shares. And then once you got those shares didn't compound. They didn't make more new shares. They didn't have babies. You just grew those shares forever, and you paid for them with your own money out of your own pocket. So you never did have a compounded growth. All right. Now there'll be models and people on talk to you about, oh, look how it's compounding. We stop at a year and we say from this year to this year, it's not compounding. Compounding means you get more shares. Until you start getting a strategy that gets you more shares, you're not compounding, all right? You're just having linear growth. And nothing wrong with linear growth. It's just not the 7 wonders of the world, okay? Nobody said linear growth is the 7th wonder of the world. Nobody said that. Who said that? Nobody. All right. So what we're doing is we're coming down here and looking at the stocks that we want to get. And the reason these yield max funds are so great, and this is the part that most people miss, is that they allow you to get more shares because they sell, they buy and sell, they buy and sell, they buy and sell. Now you can buy and sell, buy and sell, buy and sell yourself if you want to. You can go out and you can buy Microsoft, and when it goes up, you can sell it. And when it falls back down, you can buy some more using the profits that you made with your Microsoft. And then that profit would be buying more shares. And then when it goes back up, you would sell it. And then when it comes back down, you'd buy some more. And then when it goes back up, you'd sell it. When it comes down, you'd buy some more. That's called trading. That's the difference between a trader and an investor. An investor is going to get linear growth because they're not buying and selling. A trader is going after that, right? That 7th wonder of the world. They're going after the money that they're going to get from compounded growth. So that's why they buy, sell, buy low, sell high, buy low, sell high, buy low, sell high, sell high. That's the key. That's the key. If you're not selling so that you can buy more at a lower price when the market falls, you're not going to get the compounded growth. Okay. So you got to have more shares. You got to have a strategy that brings you more shares. That's, again, circle back around, weave this in. That's the reason why these yield max funds are so amazing. That's why dividends are so amazing, because dividends allow you to buy more shares with somebody else's money. Okay. The problem is that these big funds, these big companies come in, and as we were looking before, let's go look at, we're going to come in here and look at, we're going to look at Apple. AAPL, because we all love Apple, right? Apple's such a great company. Oh my gosh, I'll have some Apple stock. Is my software gonna come on? What's wrong? AAPL. How come my search is not working? There it is. A little slow today. So there, can you see the little tiny reinvested dividends, the drip line? Can you see it in there? It's 0.46%. Look at that number right there. It's 0.46%. That's your dividends on Apple. Oh, we all love Apple. I hate Apple. Apple is a miserable company. All right. Now they say they're getting their shit put together. But I just swore. I'm gonna have to go to YouTube confessional. Okay, well, there we go. So Apple says they're getting their shit put together so that they're going to start participating in the AI world. And so that's why you're seeing a little bit of a jump here on Apple. Doesn't change the fact that they're still a shitty company. All right. Len, how can you say such a thing? That's blasphemy. I know. Blasphemy to say that Apple is a shitty company, but I've showed it to you before. We're going to come over here and I'm going to show you in this little software program right here, AAPL. And I've showed it to you before. So those of you who have been here before, you already know. You already know. Look at this. They're buying their shares back. And they tell you that's a good thing. Oh, we're going to share our income with you. We're going to buy our shares back. No, what you're doing is you're propping up your stock because you ain't making no sales. You're not increasing. You're not selling anything. Look, you're shitty. For the last 4 years, you haven't sold a damn thing more than what you sold every year the previous year. And your earnings per share is staying high up here at the exact same thing because you're buying back your shares. You're buying back this is fake. This is you're pouring your money back into the market because you can't sell any product to get an increased earnings per share. Oh, we're buying back our shares. We're giving our money back to you. Yeah, you are. You're propping up your stock with fake returns. That's what that is, you miserable bums. Oh, but we're going to give you a dividend. Oh, we're going to give you a dividend. Aren't we happy? 26 cents per share on a $238 share. They're going to give you 26 cents. Oh, aren't they just so generous? Oh, what a wonderful company. No, look, it's 0.46% return on your dividend. That's nothing. Look at AT&T. AT&T is one of the highest dividend giving stocks. All right. There's AT&T at 4.69%. You almost can't get that. You go down to Cash Valley Bank and say, I want a CD. You might be able to get that right now. That's about what they're giving their CDs out at Cash Valley Banks, 4.69%. And that's what AT&T gives. AT&T is a much better company to be in than Apple. If you want to be in a company, and look, it's got growth, gain 40%. That's pretty good. Total with their dividends and their growth, that's 45% return on your money over the past year. Now, they did have a big growth spurt. You have to admit, it's not all hunky-dory all the time. But if we come on over here and we put in AT&T, you can see their chart. See, going up, up, up. Well, it's kind of gone sideways lately. But you can see that they're not buying back their shares. Well, they are a little bit, little AT&T. But look at their sales are going way down. That's not good. Oh, and their earnings per share are going down. That's not good. Oh, and they're getting downgraded. That's not good. So my little example here of a good company is still not a very good company. But they do pay a high dividend. That's why, they give you a high dividend to try and keep you in the stock. Okay, what's another one? Another one is the Verizon, VZ. I think they give a pretty good dividend. Now, a dividend is the shares of their profits, right? So they're sharing some of their profits. Apple's not making any profits, so they can't share them with you. But this is Verizon. They give you 67 cents. But again, you're going to have to do all your math. You're going to have to create your own chart. And it's quarterly, too. Look, they're paying quarterly. So we're going to come back over here to this program here. And we're going to go to, it wasn't FZ. Now I've got a short-term memory. VZ. So we come into VZ. And you can see right here, the yield on this thing. Come on, baby. 6.58%, higher than AT&T. This is one of the highest ones, too. 6.8%. You can't get that in a bank CD. I don't care where you go. There ain't no bank CDs giving you 6.58%. Now, did they have any growth? No. Well, they did, 5.8%. You can't complain about that, right? I mean, combined, if you buy both of them, you're going to get 12.47%. That's pretty damn cool. 12.47%. And that's about as good as it gets when you're trading dividends. And so this is what we used to trade. We used to trade dividends. Now, dividends was a nice thing. That's what's going to give you your compounded growth, right? Because they're going to give you the dividends and then you're going to buy more shares with it. That's what people call drip, right? They're going to drip it back in. They're just going to buy the same VZ shares again. I don't like drip. I think you should, if they give you a big chunk of money, you should look around and say, hey, maybe there's something better I could put this money in than back into VZ. Maybe there's not. So, okay, well, I'll just put it back into VZ. That's okay, as long as you're doing it yourself. You're making that decision. I don't want you just to drip because you don't know how to do anything else. Just making stupid decisions. Oh, I'll just drip it back in. They gave it to me. I'll just put it right back in. Why'd they give it to you? Oh, so I could put it right back in. No, take that money and do something with it. Nothing else. Go buy some candy and dinner with it. Go spend it. But if you're going to buy it back in, make sure you put it back in wisely. Buy low, sell high. They gave you dividends. Use that money. Go find some place you can buy low. All right. Don't just stick it back in because they just gave it to you. That's my rant and rave. All right. So this is that neat little tool that we talked about on Tuesday. And we looked up these funds, right? And we looked up this stuff. And one of the things we looked up was, hey, let's go look at some of the funds that we like. PLTY. Now, PLTY, let's go look at PLTR. PLTR is Palantir. So we can look at Palantir. Now, Palantir doesn't give a dividend, zero yield. But holy smaholies, look at this. 400% increase in value. So it went up 400%. So if you'd have bought Palantir back at the beginning of the year, you'd be up 400% on your money. Now, it's linear growth because you didn't sell along the way and you just bought some here and it's now worth more money. 400% is a lot of money though. So even linear growth can make you rich, rich, rich beyond your wildest dreams if you catch the right little firefly and the thing takes off and goes to the moon. But these are kind of flash in the pan. You don't see that very often, but this is one example. All right. And so if we come in and we look at most of the stocks, if we just go, let's think of Caterpillar, for example. That's kind of a popular one. We'll just look at Caterpillar. You can see in here the yield on that. They do give you a dividend. It's 1.5%. The gain was 24% over the last year. Now, it had a big drop like everything else, but it ended up, from here to here. That's what it's going from the beginning to the end, where it went without all the fluffy in the middle. you ended up with a 26% return. That's pretty good. 26% return. Nobody complains about 26% return. All right. That's 1.5% dividends, which you can take and buy more shares with. And then you had linear growth at 24%. And that gives you 26%. And that's that cool little calculator that's inside Portfolio Matrix. We played with this on Tuesday. Now we need to go to the next step. All right. Let's come in and look at Palantir. Only not Palantir, the stock. We're going to look at the PLTY, which is the options trading on Palantir. Okay, so they're trading options on Palantir. They're selling premium. Okay, so if you sell premium on Palantir and you put your money in this fund, look, the gain was 17%. You're like, the gain was 17%. That sucks. That's not even good as AT&T. You're right. But that's not what they're doing with the money. They're not trying to grow the money. They're trying to sell premium with the money. So you gave them a bunch of money, and the money you gave them is what they used to trade options with. And then that money just kind of sits there. Did it grow? Well, yeah, it grew a little bit, 17%. But that's not the point of the fund. The point of the fund is not to grow the NAV. If you want to grow the NAV, go buy Palantir itself, PLTR. You want to grow the NAV, that was 400%. Go grow that one. You didn't know it was going to be 400%, but hindsight's 2020, and you're like, I could have made 400%. Well, go put it in Palantir in this right now. Do you think you're going to make 400% next year? Oh, I don't know. It's really high. It might fall back down. I might lose my money. Exactly. You don't know what's going to happen. You didn't know Palantir was going to. That's why people out there on YouTube, I hate these yield max funds because I only made 92% on my yield max fund. Only 92%. I could have made 400%. Yeah, you could have. But did you know it was going to do that? No. And this is the growth. We only made 17%. They made 400%. That's what they're comparing. Why would I do 17% when I'm going to make 400%? Well, first of all, you didn't know that you were going to make 400%. You don't have some crystal ball that told you Palantir was going to go up 400%. You just lucked into it because Jim Cramer said to buy it on MSNBC, and he happened to hit one right. All right. He can throw darts just like any monkey. What we do have is we have one in the bush or two in the hand, right? When we're trading these yield max funds, it's no longer two in the bush and one in the hand. It's now two in the hand, one in the bush. All right. Did we go for the one in the bush? No, it's only 17%, but we got 75% return on our money because of the yield max funds trading options. So we went for the 75%. That's what we wanted. All right. And it ended up being, with the 17% growth that we got, 92% over the last year if you'd have been in this fund. So that's a little bit better than AT&T. That's a little bit better than Verizon, right? A little bit better than Caterpillar, way better than Apple. All right, 92%. I don't know anybody. We were saying nobody would complain about 25%. We just said nobody would complain about 12%, right? You put your money in the S&P 500, 12% is pretty good. We're happy with that. But here, this little fund right here, because they're selling options to collect the premium, 92%. Now, that's not bad. Can't complain about it. Not 400. But did you know Palantir was going to go to 400? No. So I'll take the 92. That's a nice little consolation prize. 92% return. That's okay. It's okay with me. How about you? No, I want the 400. Okay, well, make that decision right now. Are you going to put your money in PLTR and try and get that 400 next year? Or are you going to be happy putting it into PLTY and shooting for that maybe 92%? Maybe it's a little lower. Maybe it's only 50% next year. If it's only 50% next year, well, Palantir is probably not going to go to 400%. Maybe it'll lose money. You put your money in now and it goes down to 20, 30%, 40%. What are you going to do? Going to make money? No, you're going to lose money. Now, if Palantir does flush like that, PLTY is probably not going to make 92%. It might not even make any money. Maybe the gain will go down so low that the dividends can't pay for it. But that's pretty rare. Doesn't happen very often. Usually these yields are based on the implied volatility of the options, and that's how it makes money. And so even if the market's going down, the implied volatility will be high, and the premium of the options will be expensive, and they'll be selling them, and they'll be making money on them anyway. I don't know. That's why we have a calculator that we come in here. And we can see on our little break-even calculator that we can come in here and we can do a little slider on here, and you can see where it's going to be. What if Palantir loses 50%? Well, this is what Palantir would look like if it lost 50%, all the way down to here. All right. If you put $10,000 in and it lost 50%, it would come all the way down here to $5,000. That's the red line. Now, where would your, oh, this is Airbnb. I don't want Airbnb. I want Palantir. Let's see if Palantir's in here. PLT. There it is right there. Palantir. All right. So let's say Palantir lost 50% next year. Tabor's saying Palantir missed their earnings gains. So probably missed some gains because this isn't a full year. Palantir probably missed some gains. Are you talking about the Palantir fund didn't trade for a whole year? I'm not sure what you're saying there. All right, so this goes down. You lose 50% of your value, right? So this little slider, we took it down. We said Palantir loses 50% of its value next year. What happens? Well, if you own the shares, you'll lose 50%. There it is. You'll be clear down here, $10,000. You'll be down to $5,000. But what happens to the fund that sells premium against that? Well, they're still profitable. Look at that. Even if Palantir loses 50% underneath, this one here is if you cashed out, see if it gives you the number, you'd be up 14,000, and this one you'd be up 16,000. So you're still going to make a little bit of money, $6,000 if you reinvest, do the drip thing. You make $6,000 while the stock itself would lose $5,000. That's pretty cool, right? That's what that little calculator tells you. All right, so now we're going to come back to this calculator. Now we have to talk about rebalancing. All right, so we've played and we've experimented and we've kind of caught you up to speed on what we were doing with last month or last week, last Tuesday. Now let's come into the new tool, My Performance. All right, not My Performance. No, we're going to not do that one. How do I get there? Oh, I got to come out here. Here we go. Set targets. Now this little tool right here, let me kind of, how do I introduce this? I've been trying to think about how I can bring that. And I think most of us, probably everybody in this class, took algebra in high school, right? Remember taking algebra in high school? I need a little drawing pad because I want to do something. Where's my drawing pad? Where's my drawing pad? Oh, there it is. Okay, so I want to kind of draw a little picture for you. This will help. Come on, picture. This is my little whiteboard. All right. So I got my little whiteboard in here, and that'll be good right there. So we got a little whiteboard. Now, this is, see if I can make this work. Remember in algebra, they would give you a formula. So did you know that 1 plus 2 equals 3? All right, let's make that a nice big font you can see. That, how come that's not working? How come I can't see my, it's white. Nobody wants white. Let's make it black. Okay, so we got our little, this isn't working. Okay, imagine, I don't have a whiteboard. So at school on class, I have a whiteboard. I can write all this stuff out on this little electronic platform. I can't sit here and draw for you. I need a pen. I need to get one of those things. So in algebra, 1 plus 2 equals 3 is actually algebra. That's algebra. Anything that's got an equal sign in it is algebra. Okay. So if you have 1 plus 2 equals 3, that's an algebraic equation. So if you have an equal sign, what's on the left side has to match what's on the right side. Correct? Well, understand that, right? That's what an equal sign means. That means that anything that's on the left side has to match what's on the right side. Well, sometimes we have 1 plus, and we put an X, right? Because we don't know what 1 plus X equals, and we're going to put 3 over there. So now we have to solve for 3, right? So 1 plus something equals 3. We know what the answer is. We just don't know what the question is. So 1 plus So then we do what we call brute force mathematics. All right. And that's what computers do. Computers will now take brute force mathematics and it'll go through, and it's really good at doing brute force mathematics. Brute force mathematics that it says it'll take that X and it will replace it, starting with 1, and then with 2, then with 3, then 4, 5, 6, 7, 8, 9, 10. And it'll iterate through all the numbers until it matches the answer. And it will find that for you. Okay. That's called brute force mathematics. And so when you solve for the answer, that's what you're doing. You're figuring out a mathematical model that will solve for X. So you got the equal sign, and you know that you've got 1, but you don't know what X is. But you know that 1 plus something equals 3. So you're going to go 1 plus 1 equals, well, not 3. Okay, let's try 1 plus 2 equals 3. Oh, it matches. We solved for X. Okay, so we knew what the answer was. We knew the answer was 3. We knew part of the answer over here, which was 1. We needed to solve for the X. Why am I teaching you this simple mathematical formula? Because that's what we do when we rebalance our portfolio. We do brute force mathematics to get the answer that we want. Now, we can play with all kinds of numbers to get the answer that we want. But if we know what the answer is that we want, all we have to do is solve the other side. So let's say I want 50% return on my money. So you know what the equal sign is. Equals 50%. I want to make 100% on my money. Well, is that realistic? Could be, right? If we can solve for it. Given the markets that we have available to us, we can have the computer do brute force mathematics and see what you would have to own. Past performance, right? Past performance is not necessarily indicative of future results, but it's the best we've got. So based on the current performance of a specific market, we could do brute force mathematics to find out what we want, which is 100% return on our money. That's what this is. That's what this little calculator right here does. Hopefully that makes sense. I wish I could have drawn it on a board, but we're going to solve for X. And X at this point is the equal sign X. We don't know what we want until we know what we want, right? We could say we want 50%. We could say we're happy with 25%. What you could do is you could say, I have to have a certain dollar amount to live on. I want to have $5,000 a month to live on. Okay, well, now you know what the answer is. Equals $5,000. Okay, what do you have to put on the left side of the formula to get you $5,000? That's what this little calculator does. It will solve for X to get you the answer that you want. Pretty cool, right? Okay, so let's go solve for X. So what we're going to do, and it has lots of different ways to do that. So first of all, you have to tell it what you're going to use to get that. All right, what are we going to use? Well, we're going to use the stock market. Oh, well, in the stock market, I already have a portfolio. So my portfolio, if I click on it on here, let's say my UBI portfolio is this one here. So now I have my UBI portfolio in here. I'm going to use the stocks that are in my UBI portfolio and have it rebalance the number of stocks that I own. Maybe I don't own them in the relationship that's necessary to get the answer that I need, but I'm going to give it the stocks that are in my portfolio. And you're like, but Lan, there's a lot more stocks than what's in your portfolio. What if you want to go out and use different stocks? Well, that's what we were doing here, right? That's what all this stuff was. That's why I went through and I did all this work on all of these different funds to find out which ones we want. And the ones we want are in this list right here. These are the ones we want, okay? So those are the ones we want to rebalance into because I've already done all the math using this earlier little tool that we learned about on Tuesday and that we just reviewed here so that I know what I want to have the algebraic calculator solve for my number. All right. Now, I don't want to solve for a specific number. I don't want to say I want 50%. I want to come in and say I want as much as you'll give me. So I'm going to solve for X. I don't know what's on this side of the equal sign. I just want the biggest number possible. So I'm going to ask the algebraic brute force mathematics calculator to come in and give me a combination of stocks that I'm going to give a list to a combination of stocks that will give me the maximum profit based on certain mathematical models. So I can go off of relative performance, I can go off of equal outcome, or I can go off of equal diversification. Now, where do these formulas come from? Again, it goes back to my son, Ben, who went and got his Series 65, which, again, as you all know, in the finance industry, that's like passing the board exam in the law world. So if you're going to be a lawyer, you have to pass the board exam. If you're going to be a financial analyst, you have to pass the Series 65 exam. Okay. So he passed that Series 65 exam, and in that he learned all this stuff. And of course, then he went and started looking to work for these big firms like Goldman Sachs and all these people who manage your money, right? So, oh, well, we're big money managers. And so that's what Ben got his license for. He's my son. He went and says, okay, I'm going to go work for one of these big companies. And then he learned that this is all they do. Okay. He got his license, learned all the math, and came in here, realized they had a little tool that came in here, and they would say, oh, Mr. Turner, thank you for bringing us your $1 million, and you would like us to invest it for you? Oh, we only take a mere 2.5% fee to manage your money for you. Would you like us to manage your money for you? Oh, thank you very much. We would love to manage your money for you. Here, we're going to do what we call relative performance. And we're going to put in your $1 million, Mr. Turner, $1 million. And we're going to come in here and we're going to diversify it by the dividend yield. Okay, we're going to do that. And then we're going to apply that to your portfolio. And I did it wrong. I don't know what I'm doing here. This is a new tool to me too. Just let me figure it out. All right. Maybe it's this one. There we go. All right. So now we're going to go in, Mr. Turner, and we're going to apply this to your portfolio. And this is the way that we're going to balance your portfolio out so that you can get your returns. And I'm going to say, oh, well, thank you, Mr. Goldman Sachs. You are so smart. You're going to manage my money for me. Oh, thank you very much. And this is all they do. So they come in and they have this little rebalancing tool. And this, Ben's like, Dad, we could recreate Goldman Sachs' entire world, and we could give it to people and they could do it themselves, and they don't have to pay 2.5% every year of $1 million, which is $25,000 to somebody to click the little apply and view button. So that's what this is all about. That's why he created Portfolio Matrix, because he's like, they're charging $25,000 for every $1 million you got in there, just so that they can hit the little apply and view button on a little calculator that we could create and sell to people themselves. They could have it themselves. We could sell it to them for $20. I'm like, you're right, Ben. Let's develop that software for our community. All right, for my students at Utah Tech University, and for my friends and family, and for people who want it. And he says, for me, I want it myself. I said, Ben, if you're going to do it for yourself, let's create it and we'll use it ourselves. And then we can sell it and let people help us pay for the development costs. So they can use it too, but then their subscription services help us pay for our development costs. We've been working on it for 2 years to create this thing. So we got a lot of an investment in there. We want to give it to you so you can help recoup our investment costs. All right. And that's what this little calculator does. So now what it does is it comes in, it looks at your portfolio, and it says, these are the stocks you have. And this is if you wanted to do $1 million into relative performance based on the dividend yield, this is where you'd want to start your rebalance. So I'm looking at this and saying, well, in my account, I'm going to pull up my spreadsheet, right? Because I got it all in a spreadsheet. And of course, once you get this little software, you don't need a spreadsheet anymore. But I've got mine all in a spreadsheet. So I come in and I say, well, in my spreadsheet, oh, damn it, I don't even have a list, a column that tells me all my totals for the, total infusion. There it is. Okay, so I've got YMAG. Oh, I don't have YMAG in this list because I've already taken it out. YMAX Misty. Okay, MSTY. I've got that one. And Misty, I've got $177,000 in Misty. And it says in Misty, you should only have $212,000. Oh, you should have 212,000. All right. So it's saying you need to put more in Misty. All right. I've only got 177,000. And Tesla, TSLY, I've got 146,000, and it says I should only have, I don't know, it's saying I should have 156,000. Oh, now wait a second. That's not fair, because this portfolio, I don't have $1 million in it. All right. So we have to, if we're going to do apples to apples, we have to do it like this. What was that number right there? 476. Let's say 500,000. All right. Let's do the real number. 476,680. 476,680. I think I'm doing this right. Ben's given me a big lesson on this. 476,680. I think I've got it right. All right. So this is the money I started with. So apply and view. We're going to change that. Okay. Now I can pull up my spreadsheet. And you can see in my spreadsheet, again, I'm not telling you what to do. I'm just telling you what I'm doing. All right. So where'd my spreadsheet go? Okay. So now we can compare apples to apples. 476,000. So NVIDIA. I've got that in there. It says it doesn't like NVIDIA. Oh, there it goes. It rejiggered for me. Okay, so Misty. I have in Misty 177,000, and it says I should have 100,000. Now, this isn't exactly right either, because I've reinvested. I have to use a different number. Total infusion. I have to use this number. 678. 678,875. 678,875. That would be more accurate. 678,875. 678,875. That now, I think we got the real number here. Did that change? I'm not sure. There it goes. Okay. Now I think we're going to get more apples to apples here. Okay. So in my portfolio, I have in Palantir $73,000 according to this. I've actually taken Palantir out, but it's this spreadsheet is so hard to update my spreadsheet. I haven't got it current. Okay, TS or PLTY. It says I should have 94,000 in Palantir, but I have 73,000. So I need to make some adjustments. That's what rebalancing is, because rebalancing is saying, hey, if you want to get to equals on this side of the bar, you need to make a rebalance. You need to do that, this or the other thing. Now I can add stocks that I don't own into this too, and it will take those into consideration. Okay. Well, actually it does, because I don't own Palantir, right? I sold it out. So it's going to say, Lan, you need to get $94,000 back into Palantir. Now here's the numbers. Here's what's really cool. All right. Now, right now you have the previous and the new. So this is the same thing as we were looking at before. So you got the gain, which in this case, look, it's showing a negative 21% gain if I do this, but I'm getting an annualized return of 80% on the dividends for a total of 58% return. So now if my goal was 50%, I've hit it at 58.94. And you're like, well, can you get better than that? Well, let's see if we can get better than that. We've done relative performance. We started with relative performance based on dividend yield. Let's go to price gain. Now that would be the growth. All right. So we're going to do on price gain. So relative performance based on price gain of the underlying stock for my $678,000 apply. And it rebalanced my portfolio. And what it did is it took the old one, which was right here, right, this one, and it moved it over to previous. So now we can compare. We can compare the previous, the current model to the previous model. Now, the previous model said that we were going to make 58.94%. Well, if we go from relative performance to price gain, oh, look, I went up to 62.25%. I can anticipate making 62.25% because we're doing brute force mathematics to make the equal sign equal on the right side with what's on the left side with the tools that I've given it available to make that with, which are these stocks, which is my portfolio. So now my portfolio is set up to be like this. All right. It's saying I should put 83,000 into Palantir. It should put 37,000 into NVIDIA. And if I do this equity, I will get this return based on past performance or current performance. It's current performance. Okay. Now, if I'd have done the previous model, which was up here, I'd have had this return, which was 58%. Now I've gotten up to 62% return. 62%, nobody's going to complain about that. That's pretty good return. All I have to do is just not even change the stocks that I have, just change how much I have in certain stocks. That's called rebalancing. Okay. So I'm not selling off all my stocks and buying new ones, which I certainly could. But which ones do I have to buy? I don't know. I have to go and figure it out, right? Well, I've already done my figuring out my math, so I know which ones I want to use for my new, what I'm going to call my dream portfolio, right? So I'm going to eventually, by the end of the year, I'm going to move myself out of all of these into my dream portfolio based on the brute force mathematics of the algebraic equation. Figuring out what now I don't know what I want on the right side. Okay. I just want the biggest number. So I'm going to sit here and play with this until I can find the biggest number using these different mathematical models. Okay. So now we've picked the first one, relative performance, and we've done price gain. Let's come down to dividend yield. So we're still going to stay on relative performance, dividend yield, and we're going to click apply. And we got 62.25%. Now that one went down to 58%. So I'm going to write down 62.25%. That's our highest one. It only saves 2. I'm going to go through, because we're together here, I'm going to go through all of them. We're going to look at all of them. All right. And we don't know which one's the best. We're going to find which one's the best. But we've got our standard now is 62.25%. So now we're going to go to the next one. We're going to come down. That was dividend yield. Let's go combined gain plus yield, and we're going to apply that. That one went to 66%. Well, that's better than 58, and it's better than 62. So our new standard is going to be 66.28%. And that one is relative, I better write this down too, relative performance with combined gain and yield. So that one gave me the best. So now we're going to go to the next one and see if we can get better than that. Combined. Now we're going to go to most recent dividends. Now, most recent dividends is assuming that the market will continue giving the dividends at that rate. So let's apply that with relative performance. And we ended up again with 55%. Well, that's not better than 66, so we don't need to write anything down. We've got our best one right now sitting at 66% with these particular stocks. Now, these particular stocks are not the ones I have on my list. These just happen to be the ones that I've already invested in. So I'm going to have to go through and create a dream portfolio that has these in it, and then go through and it'll tell me how much money to put into each one of these. Now, there's some crossover. There's some of those that are in this list, but some of them are not in there. So I'm going to have to close out positions in there and put them into the new stocks that are in here and at the rate that they're telling me. Does that make sense? Isn't that cool? Oh my gosh, it's so cool. We're going to be rich beyond our wildest dreams. Okay. Now, that's the last one. Let's come and do the next one. So that's relative performance. Let's go down to equal outcome. Now, equal outcome is going to have the same output as the other ones. So let's go to price gain. So we're going to do equal outcome, and we're going to do price gain, and we're going to apply. Equal outcome. Oh, look, it got rid of some of them. It says you should sell some of them. And we got, if we just get rid of some of the bad ones and just keep the good ones, it says 74%. Oh, we better write that down. We can get a 74% with those particular funds if we liquidate some of them and put the money over into the others. How much? Well, you can see, well, outcome, it's going to put it all into Palantir. That's not a very wise decision. I don't know if I want to do that. I'm going to take liberty to say, sorry, I ain't going to do that. Okay, but maybe you can't. I don't know. It says, past performance is not necessarily indicative of future results, but Tabor's saying that should be NVDY instead of NVDA. Well, the problem is, Tabor, that I have NVDA in my account. I don't have NVDY, and so I'm just using my account. So it's NVDA because that's what's in my account. I don't have any NVDY. If you want NVDY, you have to go in and add NVDY to your portfolio. Say, I don't have any, but I want it included, and then it would include it. That's the next step. All right. So I can only use what's in my portfolio currently, and that's what's in my portfolio currently. All right. In my UBI account. So that's what that is. That's how that works. So that's why it's NVDA and not NVDY. So we have to stick with NVDY, because that's what's currently in my portfolio. All right. And so that's price gain. Let's go to dividend yield. Let's see what that one does. That goes down to 59%. So that's equal outcome, dividend yield. And that gives us 59%. Still not better than the 66 on the other one. So we're going to go to combined yield. That gives us equal outcome, combined gain plus yield, 44%. Not better. So we're not going to do that model. We're going to come down here to most recent dividend. Click that one. All right, most recent dividend said it'd give us 58%. Equal outcome, most recent dividend, 58%. Not better than the 66% we got before. So we're going to not use equal outcome. We're going to come down here to equal diversification. And we're going to start with price gain. Equal diversification, price gain. Now, equal diversification puts the same dollar amount in every single one. Look at that. It takes my $678,000 divided by, it looks like I have 10. So it puts $67,888 in every single one. And that would give me a 56% return. Not as good as the 66 we found earlier. So let's go to dividend yield. Still at 56%, not changing anything. Go to combined gain plus yield, apply. That's still 56%. It's not giving us anything better. Most recent dividends, apply. Didn't change, still 56. So when we did equal diversification, it didn't matter what the select diversification metric was, it gave us 56%. So that one didn't outperform our relative performance combined. So now we're going to come down equal diversification. So we've tried everything. And the one that worked the best was relative performance and combined gain plus yield. That one gives us 66%. So that's our portfolio right now. That's the best we can do with brute force mathematics against our algebraic equation using all of these mathematical models that are used by Goldman Sachs to decide how to manage your money. This is the model that worked the best for our particular portfolio to get us the highest percent we could possibly get. Brute force mathematics tells me with this portfolio, the best I can get is 66% moving forward based on current projections. All right. And that's using every single thing that's in my portfolio. Now, if I want to get rid of some of them, I can. Tabor was saying, well, what if you don't want NVDA? Well, you can right click on NVDA in the list and you can come down here and you can say exclude. Now I can exclude that one. And when I exclude it, it takes it out of the list over here. I can now reapply and I'm going to get different numbers. Now it goes up to 67%. So by excluding NVDA, it increased our gain plus yield to 67%. See, that's pure magic. That's pure magic. That's a pure magic. And then we got down here, this is our excluded one down here that we took out. Let's exclude something else. What's another one that's not seeming to do too well? Monthly, annual, this one here, NVYY. Well, it's got a, let's go back to equal outcome and see which ones are giving us the least amount of money. Misty. Well, that's, well, it'll only put 37,000 in there. Equal outcome combined yield plus, let's do price gain. Trying to figure out which one to remove. Let's just remove, I want to come back to relative performance combined, and I want to remove, let's apply that back again. I'm going to remove Misty. All right, so we're going to exclude Misty, take that out of our portfolio, apply, and we come up with 63%. So that went down. So we don't want to take Misty out. So let's put Misty back in. So we come down here, go to Misty, and we'll include it back in our selected group. And so we put Misty back in. We're going to apply. And now we're back in, and we got Misty back in there. Misty right there. Okay, so we got Misty back in, and we went back up to 67%. So see, you can go through and you can exclude one, you can include one. So let's come in and include one. What's one we don't have? We don't have snow in there. Now, let's see. I'm not sure, but I think I can come in here. Let's try this. And I'm going to look up snow. S-N-O-Y. S-N-O-W. Going to add snow. And Snow has a gain plus yield. Look at that. The gain is 105%. Oh, that's Snow. I don't want Snow. Snow is the underlying stock. So it grew 105% last year. That's pretty good. 100%. That was part of our 100% group, right? We want it's Snowy, right? SNOY is the one that the Yield Max Fund. And that's the one that does the big gains. Okay, so it had a gain. Snowy last year had a gain of negative 4%. All right. The NAV went down 4%, but it had a yield of 65%. So for a total gain plus yield, that was a 60% return on your money last year. All right. Now, if you'd have been in Snowy or Snow itself, you'd have made 100. But just on the dividends, it made 60% last year. That's pretty good. You didn't know Snow was going to go to 100 last year. Are you going to it went 100 last year? Are you going to put your money in right now? Because it could go to 100 this year. Well, I don't know. I'd rather go with the 2 in the hand instead of the 1 in the bush. So we're going to go 60.19. We're going to assume that that's a good one. So we're going to say Snowy. Is it on my list, actually? It is. That's actually one that's on my list. All right. So we're going to come in here and we're going to, now watch. See, I can add Snowy to my individual open UBI account. So I add Snowy. And now Snowy's in there. Now I can come back over to my brute force mathematics. And Snowy should be in my list. There it is. And okay, so we're going to apply that and we're going to include Snowy in our portfolio. And it says I should put $72,000 in the portfolio. And we actually get a little bit better return, 66.37 instead of 66.28 by adding Snowy. All right. Now it was a small because I didn't remove anything. Oh, I did. I excluded. Which one do we have excluded still? NVIDIA, but NVIDIA doesn't have very much money in it. So that's how it works. Now we can start excluding things, taking things out. But what I want to do is I've got now this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is 12 of the best stocks of the high yield funds. Okay, that's what this is. That's what this is. This list is the list I went through and the best of all of them. So what I can do is I can create for me a new group. So watch this. I'm going to come in and I'm going to put this back to where it belongs. And I can create a new group. And this group is called we're going to call it our dream portfolio. So this is our create the dream portfolio. And I'm going to put into it each one of these. Now, I'm not, in the interest of time, I'm not going to go through and do the whole thing. I'm just going to show you how it's done. So we're going to come in here and we're going to go to BIDO. And I'm going to add BIDO because BIDO's one of them. All right, look at that. BIDO, 70% last year, gain on our yield. Wow. Okay, so that's why we're in BIDO. And the next one is OARK. Oh, wait a second. Sorry. I got to add it. So right here, our dream portfolio shows up in the list and we add it right there. So we add that. So we've added that into our dream portfolio. Notice it's got a little ghost on it, which means that it doesn't have any money in it. All right. It's not a real market. Okay. So OARK. So OARK is one that's in our list. Look at that one, 36% return. Look at that yield on that thing. Oh, holy cow, 50%. That's pretty good. So we're going to add that one. How do I add it? Dream portfolio. Add OARK to our dream portfolio. Click that. Now we got those two in there. Let's go look at the next one. Misty, MSTY. Do we want Misty in our portfolio? Misty, we do. Oh, look at that. 86% return last year. Wow. It had a 28% loss on the NAV, which, oh no, if that's all that your little app shows you is that you lost 28%, everybody would be crying the blues. Oh no, I hate Misty. Oh, why did I buy that? I'm down 28% because that's what my brokerage firm shows me. The problem is the brokerage firm doesn't show you the profits. This one here, 115%. So when you subtract the 28 from the 115% yield, you get 86% return. Nobody's going to complain about 86% return. I know I certainly didn't last year when I made 86% return because I held Misty through this whole thing. All right. I was not complaining about my 86% return. Could I get that at Cash Valley Bank in a CD? Probably not. Could I get it at AT&T? Nope. Couldn't buy AT&T even with their growth and their high dividends. Get that one. 86% return. That's pretty good. I think I'll add it to my dream portfolio. All right. So you go through and do that whole thing with this whole list. And you're like, Lan, what's that list? Of course, I'm going to tell you the list. That list right there. I'm going to give it to you. Of course, I'm going to give it to you. It's in Track and Trade. Let's come over and take a look at it. There it is. There's the list. Now, I've got a couple extras in here. I got CVNY, which is actually didn't show up on the list, believe it or not. But I own CVNY, right? I think I have a little, but it's not on our list. And down here, AMD is another stock I thought I really liked, but it didn't end up on the list. Why didn't it end up on the list? Because I only wanted to do 10. Actually, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Oh, I did 12. Okay, out of all the stuff that we have in our list, where's our list? Right here. This one here. Out of all these, not that one, this one. Oh, no, this one. I was right the first time. Out of everything on this list, right? That's a little more than I wanted. 10,000. Okay, so out of this list, everything that's on this list. So if it wasn't on this list, I didn't compare it. I only compared the things that were on this list. And that's how I got this list. This list came from that list. And what I did is I went through, I took this list, every single item, I went into the portfolio matrix and I pulled it up and I looked and found out which ones had the greatest gain and yield. And that's how I got the top 12. Okay. And then that list, I took over to Track and Trade and I opened up and I said, these are the stocks that I want. Now, Track and Trade, now Carvana and AMD was not on this list. That's the point I'm trying to make. But yet I put it in here because I had 2 blank spaces down here. And I thought, well, let's look at some others. And so I added Carvana and AMD, but those are not on the list. So if you're trying to stay true to the list, don't include these 2. All right, so here we go. There's Palantir. Palantir we want to roll into, right? So these are all stocks that we want to roll into, but we want to do it systematically based on the movement of the market. We don't want to buy high and sell low. Because we want the NAV to work in our favor too, although that's not the most important thing. When we've learned over here that the NAV, in this case, Misty, we lost 28% on the NAV, but we made 115% in the dividend, so we made 86%. Well, wouldn't it have been cool if we could have made money on the NAV too? And that's the point of doing your technical analysis over in the charts on Track and Trade. You want to look at where we can try and dollar cost average in so that we don't lose 28% on the NAV. It would be nice if we didn't lose 28% on the NAV. That just happens to be where we lost last year from year to year, to the exact date to the exact date. So if we could dollar cost average in and get our NAV down lower and not actually lose 28% on the NAV, well, we could have made an extra 10% maybe, and maybe we only lost 14% on the NAV, right? We could make that extra 14% ourselves, and that would be at the bottom line if we're better at getting into the market and not losing the 28% on the NAV. Okay, that's the point of this. So this is NAV trading. And so we're going to come in and see if we can't do a little bit better on the NAV. And so by buying into this thing, when these things are low, these are the actual markets. These are not these markets, right? These are the dividend markets right here. These that I've got on the screen are the actual underlying stocks that they're buying the shares on. So they're buying the shares on these stocks. So we got AMD, ARKK, BD, Bitto, Coin, Carvana, Hood, Master, MicroStrategy, NVIDIA, Palantir, Snowflake, and Tesla. These are the actual stocks that are being traded. We don't ever look for the NAV. When we're trading these markets, we don't ever look at the actual market that we're trading that we put the money into. So if we're going to put the money into NVDY, well, we don't look at NVDY to determine when it's time to put the money in. We look at NVDA. If we look at NVDA, we can see the actual market that NVDY is trading their options on. And then we can see when we're going to be at the very best, most optimal time to be getting into this market. So for example, if we're coming in here and looking at, let's just use Palantir again. Well, let's bring Palantir full screen. Well, Look at what Palantir's doing. Now, we're going to do our technical analysis. First of all, we're going to find the previous high, which is right here, and we're going to draw a line across there. And we know that that's basically our Fibonacci bow tie. So our bow tie is here, 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 here. Tie it off of the bow tie. Are we going to get a perfect bow tie off of this? I don't know. Nobody knows. But right now it's setting up to give us a nice little ABC pattern off the top, right? Down here, back up here, break those blue lights and drop back down to this. Now, we also know from our research that, right, September is the worst month of the year. September is the worst month of the year. And what month are we in? Oh my gosh, we're in September. So we're probably not going to get a big rally in September. Doesn't mean you can't, certainly can. But we're probably not. Past performance is not necessarily indicative of future results, but it's the best we got. And right now, past performance is saying we're going to get a down month. So we're right here at the very 1st of September. So this is the month of September right here. And so if September is the worst month of the year, do you want to buy right here in anticipation of a rise? No, probably not. We could probably get a better NAV out of this thing if we wait for it to come down here, right? Get a better NAV. But you have to weigh that against, are you going to miss out on a dividend? Because it's going to pay you a dividend in that month somewhere. And if you don't have your money in there, you're not going to get the dividend. Is the dividend going to outweigh the amount of money that you'd make if you had your NAV in here down to here? Are you going to do the math? Are you going to try and figure that out? Or are you just going to put your money in and get the dividend and let the dividend cover the loss or get close to covering the loss? It's up to you. I mean, there's no right answer. It's just how you want to play it. Because if you put your money in right now and the market takes off and goes to the moon through September, well, you'll look like a superhero, right? Because you're going to get the NAV and the dividend. And the dividends in these markets are way bigger than the NAV, right? We've learned that. The NAV is only 28%. The dividend's 115%. You're going to get a lot more money off the dividend than you're going to lose on the NAV. So at this point, you have to ask the question, well, what am I trying to go for? Big NAV or big gain? Well, I want both. I want both a big gain and a big NAV, big gain and a big yield. I want the big dividend and the big growth. Well, right now you don't get that because the market's not giving you big growth. It's probably going to fall some more, but it might not, might go up. So where are you going to put your money? What are you going to do? Bruce says he says, I like to hold on my UBI shares so I continue to receive the dividend. So Bruce is saying his strategy, he's going to maintain the ones he's got and he's going to wait to put more in. That's a good strategy. Bruce has got a lot of experience in this. Bruce has been trading these things as long as I have. Bruce was in my very first class at the university when I very first introduced this, when I very first learned about it. So Bruce has much experience trading these things as I do. So when Bruce gives us some opinions, we should listen. So he says, I'm always trying to dollar cost average to my NAV down to bring down my share price, my NAV price. So he's always dollar cost average. So he's always looking to bring his NAV down. Okay. Then he says, I'm always trying to dollar cost average to get my share cost down on my UBI shares. Then he says, I like to hold onto my UBI shares so I continue to receive the dividend. So he's not going to sell them out like I did. I sold Palantir out because I didn't want to ride the whole drive down. Bruce is saying, no, I got in at a good price. I don't want to sell them. I'm just going to hang on to them, but I'm not going to add more in until I get a better price, which is probably the wiser decision. I took mine off. I probably should have done what Bruce is saying. I think Bruce has given better advice. We should have probably stay in and then only add on once the pullback comes in. And just use your dividends to add in. And now that's what I'm doing with most of them. I just maintained what I had and I'm not letting the dividends build up. So I have like $300,000 in cash because I haven't been putting it back in as the market gets high. I've been letting the dividends just sit. And I think is that what you're doing, Bruce, is just letting your dividends collect until markets flush down and then we can put it all back in. But on this one stock, Palantir, I sold out. Actually, I sold a couple out because I didn't want to be in a couple of the others either. But this one here, I did sell out. And maybe, Bruce, what we should have done is done what you're saying, which is just stay in, let the dividends collect, and then when this thing comes down, we can add them in later. And that's what I'm doing on all these others. So for example, well, Bitto, that one, I've got them in here. I rolled into Bitto. So actually my purchase was clear back here on Bitto, and then we rode Bitto up, and then we went to YBit, made more money on the way down, and then it showed that Bitto was making more money again, so we went back into Bitto. So I got a bunch of Bitto dividends that I haven't reinvested yet. I'm waiting for this market to come down, just like Bruce is saying. And so it's back down here we'll wait for it to make a bottoming pattern. All right. What we want to see a nice little head and shoulders pattern down here. But you can start dollar cost averaging in. It's down at the second drive. So this is the second drive down. So this is our counter trend. We've got a little counter trend and a little drive down. So we're on our second little ABC pattern coming down. And Bruce, that's what Ben does too. Ben, once he buys them, he never sells them. Now I'm gonna rebalance. I'm into some of these funds that are not in this list. So I'm going to rebalance. I'm going to sell out, which I've been doing. I'm going to sell out, and I'm going to put my funds back into this list here based on what the mathematics are saying in that little brute force mathematics calculator. But I'm also going to look at when it's the right timing to put them in too, because I want to try and maximize my NAV. So, all right, that's where we're at. So Bitto is getting down in here. It's hitting this 100% level. 130.9 is the golden ratio. We could probably start putting a little bit more back in right down in here. But the whole market's still flushing, and we're in September. So we might want to see if it's not going to come down farther. It's not making any signs of going back up yet. And we could wait for a little head and shoulders formation. Wait for a little left shoulder. Let's say it starts going up here. We get a little head, a little right shoulder. We might get something like that. And then see if this market won't take off and go up from here. But this could be the head. This could be your left shoulder. This could be your neckline. Right now, this is the head, right? So we might get a little right shoulder in here somewhere. And then it might go up in October like this. So that's probably what I think we'll look for. We'll look and see. We don't know where it's at. We're getting down here in the green. So it's saying this is all very excited down in here right now. So that's Bitto. Go look at coin. Coin has come all the way back down. Now I got out of coin and rolled into something else, which was Palantir. I rolled into Palantir. I rolled out of coin and into Palantir, and it was good. Coin did really well. Should have rolled out of something else. I rolled out of coin, but I rolled out of coin into Palantir, so I made a lot of money. I can't complain. I got my new license plate. I got my new license plate on my car. It says PLTY. I got a picture of it, but it's on my cell phone. I can't show it to you. Can I show it to you? You guys saw my car in Pit News Magazine. I had that little article that showed my little car. There it is. You can't see it. See? Right there. It's PLTY on my license plate. I thought that was funny. I thought it was funny. All right, guys. We're running out of time. I gotta let you go. But all these stocks are all coming down. They're good buy points. I mean, everything's coming into buy zones. This one's not quite there yet. BD's not green yet, so we'll wait for the green to come in here. ARC's not green yet either. Oh, well, ARC's getting into the green down here, but I want to see ARC fall a little farther. Where's the man alive? We're just going to put a Fibonacci ruler on this one. Let's see if it'll come down. Let's see if September will be hard on Kathy Woods. Getting a nice little triangle formation here, aren't we? Look at that. Beautiful. Wow. That's as pretty as they get. I think it's going to fall out the bottom. Down, it's going to flush. Of course, it depends on what she's got in her fund, right? How she manages her fund. See how hard it falls. There's AMD. AMD really had a rip, snort, and tear. Drive 1, drive 2, drive 3. Counter trend, and now we're coming down A, B, C. We're not quite back down to the 50%, but remember, September is the worst month of the year. So I think we're going to get the fall in September. Now, they're going to lower interest rates. Bruce loves Pit News Magazine. Thanks, Bruce. We ought to have you write an article for us, Bruce. Why don't you submit an article to Pit News Magazine for us? You can be an author. We ought to get you to come and be a guest speaker on here, Bruce. Why don't you come and put together something you'd like to say, and we'll let you on here, and we'll do a show together. You want to do that, Bruce? All right. So that's where we're at. That's what we're looking at. These are the markets that we want to start looking at getting into. All right. Tesla. I don't know what to think about Tesla. It's coming into that. It came into that triangle right here that we saw right here, right? A little 3-drive triangle with the flag here. It broke out the top, but it's just not got any oomph. Of course, the whole rest of the market's flushing. So, and we're coming into September. So am I going to sell out my Tesla? No, I'm going to do what Bruce says. We're just going to stay in there, but I'm not going to reinvest my dividends until I can get some better entry points. I don't know. Try to maximize my NAV. But you maximize your NAV, you sacrifice your dividends, right? This is snow. Look at snow. Whew. I'd like to see it's flushing today. So 4 big bar rallies, 1, 2, 3, 4, and then you're gonna get your flush. First green candle to make a new high. We probably ought to get some in there if you want to be in snow, because this thing's already come back, broke its mama's back. It's already gone up. This is our counter trend, and it's already started back up again. So it's coming back down. First green candle to make a new high. We might want to put a little bit in just in case it goes back up again off that. I wonder if that was an earnings, but look at this down here. See, it loved it down in there. They were buying it up right in there. We kind of missed our opportunity on that one. We were waiting for it to come back further. Now remember, well, if you decide you want to get into this market, don't buy snow. Don't buy SNOW. You want to buy SNOY, snowy, because that's the one that gives you the dividends, right? That's the one that gives you the dividends. All right, guys, we could go play with a couple of fun. I played Claire's new AI models yesterday. Should we play those again? Here, this is what Claire sent over some AI. These are AI. Obviously, these are AI. All right. These are not real people. They're cartoons. They're obviously cartoons. All right. So this is Aiden. She did one of Aiden. So, you know, those two have a little tryst going.
The other day I was sitting at my trading desk here in Sedona. The sun coming up over the red rocks. My betta fish, I named Delta, was floating perfectly still, as if he was watching the screen over my shoulder. I had a synthetic long position on, and it was finally paying off, up double digits. I sat there staring at the numbers, wondering if I should just take the money and run, or hang on a little longer and hope for more. The classic trader's dilemma. While I was thinking it over, my phone buzzed. It was Claire. She wrote, "Riley says you should cash out before you jinx it. Riley's her cat." I rolled my eyes and texted back, "Tell Riley I'll cash out when he can explain gamma risk to me. That's the kind of thing I write about every month for Pit News Magazine." The daily struggle is real, even for someone like me, who's been at this for over a decade. If you want to read more about what trading really feels like and maybe pick up a few tips along the way, check out pitnews.com and subscribe. We're all just trying to make the right call, one trade at a time.
That's so funny. She made these little AI things and she sent them over to me. These are the old ones. I'll show you. Her old one was this one.
Hey, it's Claire. If you love trading tips with a side of sarcasm, hit that follow button and subscribe to Pitt News on Air at pittnews.com. I'll be here every week, unless I blow up my account again.
That was her old one. Then she made this one of me.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
And then she sent this one over. I'm always worried about putting this one out here, but she said, play it. This isn't church. It's the YouTube. Play it.
Okay, quick question. Are you subscribed to Pitt News Magazine yet? No? Really? Then what are you even doing with your life? Here's the deal. Pitt News on Air is like the espresso shot. Quick, a little chaotic, and probably too much of me. But Pitt News Magazine? That's the full latte with oat milk, cinnamon, and that fancy latte art you pretend not to care about. Subscribe to Pitt News Magazine at pittnews.com. Because if you like hearing me panic about Fibonacci levels, wait until you read what the pros are actually writing. And don't forget to follow my weekly podcast, Pitt News on Air, where we take the best of the magazine and bring it straight into your ears. Do it now. Seriously. Because if you don't, Mr. Turner says I have to come to your house and personally explain options trading, and nobody wants that.
Nobody wants Claire to come to their house and trade and explain options trading. That's a sexy little cartoon. I don't know. I told her I'm not playing that. She goes, play it. It's not church. We're not at church. All right, guys. That's it. That's what I got for you today. Go get Pitt News Magazine. That's what this is all about. Here's my attempt at here's what I do. I played with AI. Here's what I got.
Folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
That's my skill at AI. All right, we're having fun with AI. Okay, guys, just real quick.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, we'll see you guys tomorrow. Actually, not tomorrow. We're on our summer schedule. So we'll see you next Tuesday, bright and early, and we'll run through our portfolio again, and we'll see what is ready to buy, ready to add to our portfolio. And we'll do some more rebalancing. Okay, see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.